everyone. Thank you for this introduction, Tommaso, and thank you so much for the invitation to moderate this brilliant panel. I'm very excited about it. We're going to talk about decentralized infrastructure, of course, the positive aspects and maybe the challenges, how institutionals are looking into that. And we're also going to have some questions, some time for questions, so get ready. So maybe, just to start, I'm going to do a very short introduction, and then I would like to ask you to introduce yourself, and maybe a question on how you just choose to work in crypto. What is a little bit of a short story? I know we have some regulators here, maybe they didn't choose that, but they're still working on this topic. So first we have, of course, Peter Kerstens, no need for introduction, advisor at DG FISMA, very well known to this community. Second one, we do have Leonard Franken. He is working on technology, innovation, and Tiber at AFM, and also a lecturer at the Delft Blockchain Lab, a University of Amsterdam, if I'm correct? Delft, okay. Stani Kulechov, founder and CEO of Aave. And, of course, Georg, Harer, CEO Bybit EU. Congratulations on the new promotion as well.
Thank you.
Maybe we can go from that part. Peter, just a little bit of a story of how you started in crypto.
Well, I kind of chose to work on blockchain and crypto, but it more happened to me in the sense that it was unavoidable. If you take an interest in digitalization and financial services, you have to be pretty blind or stupid not to end up close to crypto. So that's how it happened for me.
I got a more or less similar story. I came from RBS, Royal Bank of Scotland, as a manager from IT, and then I entered the Dutch Central Bank. And they said, "You're an engineer." I said, "Yeah, I got a PhD in computer science." "Well, we have something like Bitcoin." It was 2013. "Please look into that." And that was my first step into blockchain.
Mine was during actually my university years, so early 20s. I was building a lot of fintech applications, and that was, I think, the time that marketplace economies were growing. You had peer-to-peer lending, crowdfunding, and an interesting way of aggregating financial opportunities globally and access to capital. So I've typically grew up more as a computer programmer, but at that time, regulation was coming in for these marketplace economies, and I chose to actually go and study law instead of computer science back in Helsinki in Finland, where I'm originally from. And at the end of my studies, I kind of was reading a lot about different technologies and spaces between AI and also and I stumbled upon on Reddit and read about Ethereum, and that was kind of like a latest update at that point in 2016. And I was reading about this DAO hack as well, and it just got me very excited at that point. And I started to realize that this is actually an interesting financial operating system, that you can build these fintech applications, but in a fully programmable way. And that's when I also started Aave, our startup, and never looked back.
Thank you. And Georg?
I think I never actually choose to work in crypto. I was into crypto already before I started working, a few months before, back in 2012. And the funny thing is, back in the day, it was something, nerdy, that's never going to be serious. So I was then working for 10 years in the TradFi world as a lawyer. And only in the more recent years, there was the need for understanding the law, but also, especially in the crypto space, in the regulatory space, you also need to understand the technology. And yeah, I think that's when finally I was the right person in the right place.
That's why now you see why I'm so excited about this panel. So today we are going to talk about the technology. We're going to see what has happened until now and where we are at this moment. We're now in December 2025. December is a good month to think about, what has been done, what have we done in the last year. But as an analogy, what has happened from maybe 2016, you mentioned, Stani, at this time, the reason we are all here is decentralized infrastructure. So how it has evolved in the last years in terms of technology, markets, and then of course later we're going to talk about institutions and other looking into that as well. Maybe, I don't know who could start, maybe Stani?
Well, at least from a technological perspective, I think a lot has changed since 2016 and 17 up to this point. I think first of all, programming a lot of these protocols has become more easier. There's a lot of tooling and a lot of different challenges that we were facing a few years ago has been solved or understood better. And I think when it comes to things like the underlying blockchain networks, there's more understanding on the security concepts around these network and the networking itself. So there's a lot of involvement, and also the scaling strategies of how we can actually scale these networks for mainstream down the line. And I think from the application layer and application protocol layer, I think in decentralized finance we've progressed quite significantly from a world where we saw a lot of experimentations in a new way of programming financial protocols into seeing actually protocols growing, becoming more and more battle tested and a public good and resilient. And I think for me personally, a big moment over the past years has been the biggest fallouts of, for example, the FTX and similar centralized financial services and exchanges on the crypto side, and seeing DeFi being able to be resilient and keep being battle tested has been quite significant improvement. And at the same time, stablecoins has been evolved. So when I started building on Ethereum, at that point, 16, 17, there wasn't any stablecoins as well. So all that infrastructure and ability to exchange assets in a self-custodial way atomically evolved, and the on-chain liquidity evolved. So I think DeFi looks very different than the early days, but it's still in a very early infant stage.
Anyone wants to comment, Leonard?
Yeah, I like to comment on that one. I think since 2015 we've seen a lot of technological developments. I would almost say that in the earlier conversations there was there is a fragmentation in supervision. But what I say, well, supervision will probably centralize towards 2029, 2030. But if I look at the blockchain space, it's fragmentized. We see more and more blockchains popping up also in the private sphere. And that's a worry to me, that there is a humongous amount of blockchains that each have their own risk on their own. On the other hand, we also learned a lot. We learned a lot more about decentralization and how complex it is to create a perfect DAO and how easy it is to game them. And I think we're still learning on that aspect, that creating the perfect DAO is still a challenge, to me at least.
I kind of feel there's not going to be ever a perfect DAO.
Let's agree on that one. But having said that, I agree that lots of things are getting battle tested. But we must be aware of the fact that by the fragmentation in the blockchains, we don't introduce new risk by disintermediating the current business, but introducing new intermediaries to link those blockchains, to glue them together. So I think we need some more development on that space.
Yeah, if I may touch on this point also from my background, having those two hats of, you know, the technology nerd and the lawyer, I think what is clearly noticeable is that technology has advanced a lot, especially in the first years. I remember back in the day it was Bitcoin, and people were saying Bitcoin is going to replace US dollar. Before we had even stable coins and layer 2 and whatnot. We've developed technology much further, but on the other hand, I see that the legal framework has not developed further. We've seen now in the last years, I think you're all aware of it, a big push towards centralized infrastructure, so especially centralized exchanges with MiCA. Centralized stablecoins, centrally issued token. Those are all now, I think, fairly well regulated. But staying with MiCA, any actual Web3 applications are excluded from MiCA. This means it's more or less still unregulated, but this also means that maybe, and for example, this is a very concrete topic that we're having at our company, maybe it's an alternative investment fund, because you can't, you know, not applying MiCA doesn't mean something else doesn't apply. And it goes even further with, if you go into civil law, because we see that many of those technologies work, but when it comes to making sure that you actually have the right, for example, to own a token, to pledge a token, to get back a token from a custodian, a lot of legal framework is lacking.
Peter, do you have a comment?
Well, the biggest development I've seen since 2017, which is the first time I ever heard about Bitcoin, was somewhere early 2017. Before, I'd never ever heard of it, was that there is a lot less attention now to the actual technology and more to the applications. And that's a good thing, because in the early days, for me, 2017 was early, I would come across a lot of technology people, libertarians, anarchists, hoodie-wearing people, geniuses. Most of them were crazy. Some of them should be in jail. Some of them are now in jail. And while that was interesting, I didn't really understand what they were talking about. And now we see much more mainstreaming of application and people who can maintain a conversation at a level I can engage with them. So when people start going on about the technology and so on, I switch off because I'm too stupid for that. I don't understand any of that. But we see really a mainstreaming and a maturing, because as with many things in life, only the geeks are interested in the actual underlying technology. Real people, the real economy, is just interested in the application. If you're a car fanatic, you want to know how the engine operates and what horsepower it has and so on. If you're a normal human being, not a car fanatic, you just want to drive a car and you want it to be safe, and that's all. And the same is a bit with blockchains. Most people are not interested in how blockchains work. They just want them to work.
Yeah, but I still think this is what you're saying may be true, but the fact that in current boards there is no engineer or technician available, at least with some decent knowledge of the blockchain, that's cumbersome and that's worrisome. And also at governmental level, I think having understanding of the technology is key in this digitalizing world. You cannot do without, because being involved in fighting cybercrime, and also being at the Delft University of Technology, know all too well what can go wrong and all too well how you can manipulate the system. So I think that knowledge, the deep understanding of the technology, is needed. And I looked at the room over here. There are more gray suits than I have in my, and that's something. The geeks are not there anymore. The hoodies are not there anymore. But I think you need them to develop this decentralized finance world, because we're not there yet. You need those geeks.
No, I agree, but we also address that both in MiCA with fit and proper tests. So basic people, what does that mean? That you actually have to understand what it is you're doing, what this technology can do, what it can't do. But more importantly, and this is not often not raised often enough during crypto discussions, People always go on about MiCA this and MiCA that. The DORA regulation, digital operational resilience, is far more complicated and far more important here. And that is the place where we say as Commission, and now the EU, because this is now legislation, is that if you are a financial institution, you have to own and understand the technology on which you operate. And this has to be at the highest level of your organization. If you are a banker and you have no control, you have no understanding of the technology that the bank uses, you shouldn't be the CEO of the company. If you don't understand it, you have to surround yourself with people that do understand it, because technology, whether it's traditional technology, decentralized technology, is the driving force of finance. And you need people that understand this. What they wear doesn't really matter. It's what they know and what they can engage. And some of the technologists are great at the technology, but they're not that necessarily good at understanding financial risks or how markets operate. And some people who understand very well how markets operate, or how counterparty risk operates, or what macroprudential risk is, may not understand how the technology works. And you have to sort of bring the two together. And that is what we've been focusing on for the last 5-6 years with MiCA, but also with DORA. And so this is basically a call for attention, is that if you think you figured it all out because you finally read through MiCA, you know that half of it is nonsense. There's another piece of legislation. It's DORA. It's far longer and far more complicated than MiCA.
I can only agree that MiCA actually seemed, I always joke, like the easiest was MiCA, the second most difficult was DORA, and the most difficult thing was getting a bank account.
I would also say, like, I definitely I'm not a big fan of like kind of like defensive regulation, in the sense that if you think about the car example, you know, I kind of think that the innovators of the space also lead with safety. For example, we had cars with seat belts done by car companies that really wanted to invest in safety and knew that they could sell more cars, right? Airbags, and then afterwards that becomes regulation. So I think one of kind of like my biggest hope is that there's enough space to figure out what this technology and the application and use cases can be, and then recognizing the kind of like gaps and issues and what could be the protective measures. And I do think that a lot of the innovators in the space are really there to build for good and can set a good example and good standards.
So we mentioned DORA, we mentioned MiCA. I wanted to mention something else for maybe the ones in the room that are not aware of, but I think that most of you are. The Commission has published a research last year, so it's already a year old, but I think it's still interesting, and it's very, I would say, aligned with this panel topic. It was a research on decentralized finance and as opportunity in a way traditional financial sense as well. And Professor Fabian Schaar has written, I'm going to quote just a part of it, and then of course ask Peter, I would say, for comments on that. But it's saying in a conclusion that similar to the internet, many of the applications built on this foundational infrastructure will likely be centralized and regulated. Yet an open and neutral base layer fosters innovation, competition, and development of the new use cases.
Well, a professor said it, so it must be true. Joking apart, what that study really says is that regulators, policymakers, should stay away from making technology choices. They should allow different technology solutions to develop, and basically sort of said, look, while there's been a long debate that's now coming to a conclusion as to whether in finance the change should be private and permissioned, or public and permissioned, or permissionless, and so on, said, look, that really is not for the regulators to say. That really is for the market to determine what change will appeal. Now, part of the financial industry is in large part to blame for the hesitation regulators have had with permissionless chains. Because it's the financial industry, the traditional finance people themselves, that did not want to go into a permissionless environment. Until they woke up and said, well, if we're going to have it permissioned, what's the point of doing a blockchain to begin with? They realized that if you're going to go the blockchain or the DLT route, at least the base layer has to be open and permissionless. If you need to have permissioning, you can have level 2s and layers and application layers where you can have different permissioning. But if you're going to close the base layer down and make it permissioned, then you're basically denying the fundamental advantage of this technology and of this paradigm. And the initial hesitation in the industry about this has led to the attitude of regulators to be extremely cautious about permissionless chains. Because, and this is important for people who are involved in public affairs and in lobbying and dealing with regulators, is that many of you have demands. You have to think very carefully what you ask for, because very often you get exactly what you ask for, especially if you're influential, if you're powerful. Powerful forces were asking for restrictions, and what they got was restrictions. And then they realized, oh, we don't want these restrictions. So think carefully what you want for. And this study says policymakers, regulators should not regulate technology. They should allow the technology and let industry, let the market choose which models they want to use and own that choice. Take responsibility for the choice. It's not a regulator that has to say, you have to use a permission chain, you have to use a permissionless chain. Companies that build applications on this, regulated companies, choose whatever they want, whatever suits their needs, and therefore they have to understand the technology, because if they don't understand the technology, they can't make an informed choice. But once they make that choice, they have to own that choice and bear the consequences and the liabilities that come with those choices.
Any other comments on where is the line between technology and regulation?
No, I think Peter is right. Regulation should not be about technology, but what have we seen in the past with MiCA? We're regulating a technology, more or less. Otherwise, we'd have an expansion on MiFID or something like that. But those choices are being made, and I think for proper and good reasons. And I agree with you that like the internet, the TCP/IP protocol brought a lot of wealth by integrating voice, data, and video. And now we have a chance to integrate financial markets, payment instruments, and the crypto assets and the real-world assets on a common platform. But then we should have a common platform. And I see at the moment a lot of diversion in that technology area. So, but maybe in 10 years' time we say we have a TCP/IP for blockchain, and that would be big time. Yes, great.
Maybe again one insight from having two hats. What I think is very difficult in practice is that we mentioned the tech people who are really into the technology. But on the other hand, especially on the institutional sides, we have the risk managers, the compliance people. And in my view, the way problems are tackled or the way safeguards are set are completely different. Let's deal with a very simple example. In MiCA, we have a lot of basically do's, how you, about transparency, about your organization, and many other things. So it's a lot about trying to define the ideal regulated player. Whereas if we stay with the very simple example of Bitcoin blockchain, the assumption is we assume that everybody wants to cheat and defraud us. Let them try, but we make it mathematically virtually impossible to do so. And I think those are two fundamentally different ways of thinking and tackling problem, but in the end we want to bring those two together, because it's the tech people who think of these concepts and develop it, and then the compliance people, the risk people, the DORA people who need to implement it and who will also be held liable for implementing it. And this is very often where I see where it becomes difficult to basically matching those two worlds.
I could add to that, actually. I think that's a really exciting point, because a lot of the things that you can do, let's say in decentralized finance, you basically can establish protection by design and for example, for a network like Ethereum or Bitcoin, that design is sort of a mathematical proof, and the difficulty that comes with it. And the same applies with then on the smart contract layer, where you can engineer these smart contracts in a way and design that you really limit sort of certain types of risks. And it is a new world in the sense that typically, like a lot of the financial regulation is there to protect a lot of the situations of when users are giving their funds to someone, right? So, but in a non-custodial world, that perception is an approach is different when you have the custody of your funds, and also transparency. When you think about decentralized finance, you have that end-to-end transparency that comes from the blockchain and traceability, up to the point that you could create actually better financial decisions because you have the full visibility that isn't reflected on a quarterly basis, but actually on every second for anyone that is auditing the system. So I think this is a key point, in my opinion, to understand, because once you understand like what this new substrate provides as a protection mechanisms and designing well, you can mitigate a lot of these risks that traditional letter of law used to protect, for example, and doing it more efficiently.
Okay, I agree with you. You can program a lot, but there's a Nobel Prize in 2015 by Mr. Hall for contracting completeness. And that more or less says you cannot build the complete contract. So you cannot be perfect. So we have to be aware of that when building technology and building stuff. And that's where regulation or law comes in, I would almost say. It's where we need it. But indeed, I would love to see smart contracts more accountable with respect to the regulation that's there. So that would save us all a lot of work, because the owners themselves can see if they are trespassing.
Yeah. I think regulation is just a tool, right? So, and I think that you kind of you can use on the regulation side what works where smart contracts doesn't help, or underlying blockchain doesn't help, and that comes into play. But a lot of the things I see in traditional finance, just like purely like the economical or technical perspective, can be solved with smart contracts. And I don't try to be a naive or in this approach, but I think it's just a different type of a paradigm on how to approach of mitigating issues. For example, when you give custody of your funds to someone, but at the same time, like for example, on a non-custodial access, mitigates that risk, but it introduces another type of a risk of how do you secure your assets, and if you provide a service for wallets, how do you educate users at the same time?
So talking about the decentralized world and traditional financial world, now there's a lot of interest coming from institutions also to understand the technology, to understand the application layer, to understand how the interaction would work. So I have a question for all the panelists as well. Like, how do you see this relationship being built between the blockchain decentralized ecosystem and traditional financial ecosystem institutions? I know that, Georg and Stani, you work a lot on this from a more practical point of view, and of course, the regulators more from a regulatory point of view and seeing those different interactions. I don't know who wants to start, maybe Georg.
I think it's a very difficult question to answer, because the crypto scene is already quite diverse. We have, customer-facing very simple things like the bank's customers also want to be able to invest into crypto. That's one way. Then we have payment or implementing stablecoin-based or proprietary payments, central bank digital currencies. Then we have the whole topic of tokenized shares and other assets. And I would say you see a lot of interest in general about everything. We've also been in talks with many banks. But to be honest, to this date, maybe we've seen a couple of good implementations where banks also offer crypto to their clients, meaning implementing either their own model or some white label model. But so far, I still haven't seen an implemented good case practice that actually has been proven in the market. But I'm confident that this will hopefully change in the next 2 or 3 years.
Okay, so you're optimistic.
Yeah, definitely. We have everything we need. It's maybe coming back to those two worlds of regulatory and technology. We just need to, figure out the last details.
Anyone else?
I think I'm also pretty optimistic about it, because what I see in the Dutch market on experiments of banks with blockchain, that they are seeing operational efficiencies in the integrating in their current legacy systems. They also see that they can abandon legacy systems because of this shared platform. But this will take time, yes, because they have to divest certain investments that they did in the past. And that's not a simple decision, because then if you invest in what are you going to invest, what choices do you make? And that's quite a lot of money involved. And banks, well, they're doing well, but not all of them do pretty well. So that's for a crypto market where the investors are queuing up to invest money. That's fun, that's nice. But if a bank says, well, we're going to abandon or divest our current infrastructure, and we need 200 or 300 million euros to create a new infrastructure, that's a hard sell.
Is the sell going to happen?
I would also say that, at least from our point of view, is that institutions are actually less interested in crypto assets and more interested in, these tokenized assets. And I think that's a very exciting, because we kind of proved along that, DeFi works really well with these native crypto assets that were kind of the first wave, and tokenization can actually bring a lot of value for institutions. And I think down the line, it actually pinpoints into reducing the operational costs. And obviously that's very difficult to do, because finance itself is so overly optimized space over decades and decades and so forth. But I think as we start to tokenize more products and have more utility from DeFi, the size of tokenized assets and DeFi will at some point overgrow the kind of more native crypto assets like Bitcoin and Ethereum and so forth. I think that's where a lot of the institutional excitement is from our experience.
Maybe let's mention some of the challenges as well. We talked about potential of, like you mentioned, tokenization. I know that there's, discussions around privacy when it comes to decentralized infrastructure. There's discussion around interoperability, maybe a few others linked to cybersecurity. How do you see that, and how to best prevent? What are the solutions? Are we looking into regulation at the moment? Is standardization a better way? Should we develop more tools or infrastructural projects to solve these challenges?
Well, first of all, you need standardization. That's also for the bigger companies to step in and have interoperability. Standardization is key. Yes, privacy is key as well. I don't think, I know quite some high-frequency traders, they don't want to share their IP on their trading strategy. And on a blockchain, that's pretty transparent. So there, not even privacy, it's more like secrecy. So there we have to create an infrastructure that can balance public, private, permissionless, and that's a challenge. But I think that's the way forward for me.
Now, as Commissioner Albuquerque said this morning, the way we see it is that distributed ledger technology and tokenization are becoming the operating system for financial markets. But we have, in traditional computing, we have different operating systems. Now, luckily, we do not have as many operating systems as we currently have level 1s and level 2s, but layer 1s and layer 2s. But there's going to be a number of them. We have no preference for any of them. That really is the market and the development market development that should determine which ones will prevail, and regulators should stay out of this, should not pick winners. Sometimes my day looks like that I'm in the jury of a beauty contest, because all of these layer ones come and sort of say, please tell us that we're the prettiest. And I say, look, I'm a bad judge of this, don't ask me, you're all fine. I wish you a lot of success. Build something useful, and if you build something useful, build a useful application that will lead to more success for your layer one. Demonstrate that you're useful. It's not whether you have most features, it's whether you're meeting a need in the market, or you can create a need in the market that's going to give you success. What we currently have is a number of different protocols that are all very efficient internally, so what we call sort of efficient islands, but they're separate. They're often not very interoperable. We're building interoperability, or industry is building interoperability, bridges, and these bridges are clunky at best. And that's where security risks lie. They often sit at these connection points. But what can we do? Maybe we should wait until some of these islands become bigger and push out the others. Maybe these bridges should become a bit more solid and a bit more performant. But that really is for the ecosystem to work out and to develop. And we only see progress in those areas when crypto markets are down. When crypto markets are up, most of the developers spend too much time, all of their time, speculating on their assets and talking Bitcoin up to whatever level, and they lose their focus on building useful applications. I have nothing against crypto trading. If people want to gamble or trade their life away, knock yourself out. But how useful is that really to society? If you look at the uses and the useful applications that you can build on a blockchain that really serve organizational or operational challenges and needs for financial market infrastructures, for logistics, or for any other sector in the economy, or to build a Web3 environment based on decentralized technology. So last year and the year before, everyone was going on about Web3 and this is going to be the future. Now no one is talking about Web3 anymore. They're all talking about boring stablecoins. I think the conversation has to go back to Web3 and all the excitement and all the opportunities that are on offer on there. I've got nothing against stablecoins. Stablecoins are necessary. But really, if stablecoins are all blockchains have to offer, why are we bothering?
I think we have much more to offer as an industry, but stablecoins, of course, are a very interesting utility as well. So in the past, as you mentioned, the European Commission is working on this topic for the last 5 years. We have regulated crypto assets through MiCA, not the technology, not the underlying technology. We have partially regulated the technology or some requirements when it comes to DORA, but now we're talking about tokenization. And of course, everyone here in the room is very much looking forward to see the part of the Savings and Investments Union, specifically on the DLT pilot regime, being published in 2 days. There's not that much, I would say, regulation or touching upon infrastructure there as well, but it is a very important thing for everyone that wants to tokenize assets that we have regulated before through MiFID, MiFIR, and now the new thing that we're introducing there is really the infrastructure. So again, maybe Peter, if you want to comment a little bit on that. I know you have talked and mentioned that, and it's going to be one of the most important topics really here, but from a lens of an infrastructure point of view.
Well, the DLT pilot regime does not regulate the infrastructure at all. What it does is it recognizes that our existing financial markets infrastructure regulation, be it the central securities, depositories regulation, finality rules, MiFID, what have you, that those were developed based on the traditional technology stack. And therefore, they are not neutral and not agnostic as to the technology used. And while we struggle to identify precisely where these legislations prevent the use of distributed ledger technology in tokenized financial instrument markets. There are barriers. And what the DLT pilot regime says is that, look, MiFID, CSDR is not technology neutral. It assumes the use of traditional technology. We do not yet know what the rules should be or will be in the future once everything will be tokenized, and I think that is the future. In the meanwhile, let's let people develop DLT-based solutions in financial markets, and we're going to give them a number of exemptions from the traditional requirements where we can demonstrate that if you do not have an exemption from the rules, you can't actually implement a DLT-based solution. So we're not regulating DLT, we are enabling DLT use. That really is the DLT pilot regime in a nutshell.
Okay. Can I ask a question? I had the impression that in the DLT pilot regime, a company is allowed to hold and the MTF license and the CSD license. And then, yes, they need to experiment with DLT because DLT allows you to do both at the same time. And to me, indeed, in the old regulation, CSDR and MTF, those are two different entities and you're not allowed to be one at the same time. And that's what the DLT pilot regime is recognizing, that this shared infrastructure is allowing you to be one at the same time. Yeah. So that means that under the DLT pilot regime, you need to experiment with the DLT, and that's every now and then a challenge. But tokenization is something we already do since Black Monday 1987, I would say, when the dematerialization kicked in 1994.
Now that's true, tokenization, but of course when we talk about tokenization, that's really code language for blockchain-enabled financial instruments. Although it's a bit of a misnomer because these things aren't tokens. Just like Bitcoin isn't a token, Bitcoin is just an account entry on a blockchain. That's what Bitcoin, it's a value at an address, so it's not a token. But everyone calls it token, so that's why we call it tokenization. But it has nothing to do with tokens. But you have to call the thing something.
Also, when it comes to tokenization, I think there's been a lot of discussions about the regulatory part, like the DLT regime, which I think is going into the right direction. However, I think very often we still forget about, I call it the last mile, the last legal step, that, in theory, I think we would have the technology and also the regulatory framework to, let's say, tokenize real estate. But speaking of the example of Austria, the land register doesn't allow my blockchain, any blockchain, to write to it. I'm saying this now very simplified, from a technology perspective, not an issue at all. Unfortunately, there's a law which doesn't mention that you can also write directly into the land register. You need a notarial deed. Similar with tokenized stocks. At least in Austria, it's very clearly defined how you can issue stocks or shares in a company, and you can't natively tokenize those. There's no physical reason why this wouldn't work, but again, this last mile, we need to go actually into the Austrian law of stock corporations, and we have to do this in each and every country because it's not harmonized. And I think only then we will finally be able to upgrade the TradFi world into a new financial world.
The last question for Stani. Stani, you were a visionary for a really long time, started very early in the crypto scene. What do you see in the future? How is the future looking when it comes to tokenization related to Aave? Maybe stablecoins as well, connected to, I don't know, the future of Aave and institutional side as well.
Yeah, I mean, I think definitely like the future of finance is around upgrading the existing rails in traditional finance into this kind of more transparent, open rails that the on-chain provides. And I think there's three components there, and one is DeFi, and why? Because you basically have these protocols or public goods operating in a way that they provide the best possible execution because of the open, competitive nature and public open source nature of the ecosystem. And then I think obviously stablecoins, one form of tokenization is going to keep growing, but then tokenization of assets is, I think, going to be a really growing theme. And especially because it's a way to actually then scale these DeFi use cases, because there's a very limited value on using these native assets like Bitcoin and Ethereum and creating interest rate markets and so forth. But actually what's going to happen is we can start using the very well-proved protocols that work really well and applying that to these more traditional assets that are on-chain. And I think that's the kind of exciting part, and the progression is going to be really slow. So I think getting DeFi more used or the blockchains more used in traditional finance is going to take a couple of decades, and the transformation will take pretty much forever. And we know that because the existing financial infrastructure has a lot of legacy systems that are still in operation. But second is that end of the day, it is the financial infrastructure, and finance is fragile, and you need to retain the trust. And that's also very important for decentralized finance, because innovators that are in the space are constantly trying to build upon this trust and building these applications and protocols that could benefit everyone. But end of the day, the kind of like big picture here is that if everyone can get access to the same financial opportunity with the equal transparency, I think we have something more better than exists today.
Thank you to the panelists. We're at the end of our panel. Everyone, don't worry about your job or this type of discussions. It's going to take decades, but we are optimistic at the end of the day. So hope to see you next year as well. And thank you very much for your attention.